Hello everybody, hope that you are very well and welcome to this evening's Contenders live stream where we are going to be going over the 80% probability trade setup. Obviously last week we ended up going into the live trading, which wasn't so much live trading. But nevertheless, we've been waiting for this. We've been ready for it. I've been hyping it up. Obviously over here in the chat, everybody's looking forward to this, as you should be, because it's going to be a really, really good one. So let's go into it tonight. So this is what we're going to be starting with. I'm gonna briefly cover link chart of the week. Just so it like warms up your brains, you're ready for what I'm going to be covering. So then we'll spend 5 minutes on link, and then we're going to go into the trade setup. Really explaining exactly what you need to look for. Okay, what we're looking for, what the triggers are, and the confirmation of when it's time to take the trade, when it's not time to take the trade. I've got over the past week we've had four trades set up under this criteria. Okay, and all of them have traded well, so it should be called the 100% trade setup. But that's a nice one. But yeah, that's what we're going to be covering today. And then if we have time, it kind of depends how long this goes on for. It might not take me an hour. I'm not sure. If we have time, I have a little surprise for you to cover at the end as well. So we'll see how time goes on in time. But yeah, stay till the end. And let's start here then with, let me just check. Everything's good. Yes. So let's start with link chart of the week just to get your brains warmed up. Let's go 5 minutes and cover this. By the way, if we do get volatility here on Bitcoin, I am going to have to totally ignore it. I'm in a trade. So I am in a trade from $9,280. So I'm in the trade. I'm going to block out Bitcoin and I'm just going to focus on the lesson today, because otherwise I am going to get too distracted and I don't want that to happen. So yeah, I'm in that trade. I'm just going to have to forget about it. So goodbye Bitcoin. Let's go over to link a second. So link, let's just take this really, really, really simply. Obviously what I was going to present last week, as it's far from over, isn't it? So we can kind of just remove that because it's already gone miles above. So obviously we can see really simple. So it's really simple stuff. And although I am I'm teaching more advanced theories, let's say like that. Well, I'm teaching more advanced theories. The more we progress, the more videos that we get through, the more advanced the context gets. Okay, so we cannot though forget what we kind of started with. Everything that I've taught you thus far is still really, really, really crucial information. So although it's nice to know about the footprint charts, it's nice to know how to use Sierra charts, Exo charts, Atlas, these are all benefits, but you cannot forget the core key theory. Okay, it all starts with our horizontal levels, doesn't it? And here link is a pretty nice example, I suppose, where we've had reactions off of all four of our key levels here. Obviously from the weekly, where you originally found support there, loss of it, reclaim, you actually smash straight through monthly, but you come up to this really big SR level of this top weekly, and you can see here this is the 8-hour chart. Resistance, breaking through, actually swing firing the lows, coming back up, resistance, and you've just started to try and claim this as support. So we can see that this is an important level on link. And what's our key theories? It's horizontals and it's Fibonacci, isn't it? So have a guess where we're rejecting from at the moment on link. I'll give you one guess and I hope that you get it straight away. It's obviously the 6-6. So we're taking our Fibonacci here from the high to the low. You can see there, almost to the sat link running into the 6-6 and rejecting. So now we've got a smaller range going on here, haven't we? Potentially starting with 6-6 resistance back down to weekly support. And what we can say is pretty simple stuff. I mean, if we lose weekly, okay, then we're probably going to be looking at this in some form of channel. So we're always building the theory, the same theory that I've been teaching you. It's still building up, it's building up. But we don't forget how to trade. This is all just simple stuff. You can see the low of the channel, high of the channel, low of the channel, partial rise, coming back down to the low of the channel, low of the channel. There's the middle of the channel with the CC confluence, and then you've got the weekly just below you. So how is this for technical analysis? You're seeing all of your theories coming together now. So what would I say is next? Well, I would actually say next, okay, if you lose the weekly, come back down to the low of that channel once more. Okay, or possibly you can always remember this pull to this pull, the 618 of this low. If you lose that weekly and then you lose the channel, then you have this 618. On the flip side, if we can break this CC, so if we break this 6-6, then I believe that you'd be moving up towards the daily. Okay, I trade link. Well, I used to trade link a lot. I actually don't trade link so much anymore, if I'm honest with you. Like de vez en cuando, I trade it from time to time, but nowhere near as much as I used to trade it. And, when I did used to trade Link a lot, and I mean a lot, the respect that it had, it's always had respect off of this CC, like the 6.6 on Link, Link, Basic Attention Token, ZRX, these were my like 3 favorite altcoins to trade, because the respect of this 6.6 is time and time and time and time and time again. Like, it's amazing. So, this Fibonacci level literally is amazing. So if you break that, I reckon you'd head up towards that daily on Link. Okay, really, really simple stuff. Then you're going from level to level. Okay, you break down from this weekly once more, bottom of the channel, 618. I mean, just trade it level to level. That's as simple as it comes. I think Link for me is one of the most technical one of the most technical altcoins out there. It does respect technical analysis really, really, really well. So. That's why it's one of the only ones on my altcoin list. So yeah, that was obviously Link chart of the week. It was from last week originally, when the longs were down here lower, but you've pushed up here. You've seen how this weekly's going, and then you've seen the Fibonacci just perfect there. So that's just a quick starter video here on Link to get you warmed up for what we're going to be approaching now. So there's Link. There's a little introduction. So. Let's move on into the trade setup, and you might have probably haven't noticed yet, because I've only just started doing it, but I myself have started taking mentorship on keynotes, so how to efficiently do presentations, because I myself want to just keep improving now as a mentor. I feel as if I've nailed trading, so let's nail teaching. So I've taken some mentorship of keynotes, so you might notice a slight, hopefully, I hope anyway, upgrade in my presentation style, and this is going to get better week after week after week and after week. So I'm looking forward to advancing as a mentor. So the new style, let's go, let's make sure this looks good. And yeah, I hope that you enjoyed tonight's stream. So the 80% trade setup, let's begin. Got to start just by showing the disclaimer, obviously. So just, pause the screen, read through that as always. That was obviously Link chart of the week. We come over to chart of the week. And so here we are with the 80% trade setup. All I would say is please do yourself like the biggest favor and turn off Bitcoin, turn off the charts. A setup's going to be there next week, a year in a year's time, 10 years time. The charts are always going to be there. This video could potentially make you a much better trader overnight. So turn off all distractions, turn off your phones, turn off everything, and just give me your full attention, and you will reap the rewards by doing that. Okay, so with that said, take out your notepads, take out your pens and pencils, get ready to learn, because here we go. The 80% trade setup. This is a really, really nice one. It kind of combines our theories of here you're going to see it. So let me just load up this. I know I have to do this on my other screen. There we go. So as far as we know from past streams, okay, so this is a series that I've been doing, isn't it? We're on like episode 10 of the volume series. So we've done a lot of work thus far under volume, okay? And we know from our past streams that price remains range bound more than it is trading. How many examples have I given you now of it's been such a bad idea to buy or sell the breakouts, and you've been much better off actually just trading the range, and that's buying support and selling resistances. And this is down on the 5-minute chart up until the daily charts. There's ranges within ranges, and you're just much better off trading these ranges because price does remain range bound more than it's trending. Okay, so with this information, we are more inclined to want to long the lows of a range and short the highs instead of trading for breakouts constantly. Okay. The 80% setup that we have is when the market opens outside of the previous day value area high or value area low, but then becomes accepted back into the value area high or value area low. I would just like to say now, if you have any questions, I'm going to hopefully answer many questions during the stream. So don't start writing questions straight away. Just give your concentration to this. And then if you have any questions, save them to the end. Okay, because I'm going to hopefully answer a lot of them. So, what we're on about here is the market opening outside of previous day's value. Okay, so from the past streams, you'll know you have your point of control of a range, you have your value area high of a range, you have your value area low of a range. So what you're looking at is the market the next day opening outside of value. So that is outside or above previous day's value area high, or opening below previous day's value area low. So it's opening outside of value. Okay, and obviously if you open outside of value, one would expect continuation. If you get acceptance outside of that value with volume increases, then you're not expecting price to reverse back into previous day's value, are you? And if that is the case, then the market's not doing what the market wants to do. If it wants to move down and it starts getting accepted back into previous day's value, well, the value has not shifted from yesterday. The perception of value is the same. Thus, you expect that full rotation back into the high or low of the previous day. Okay, so the acceptance is classed by 2 consecutive 30-minute candle closes back within the value area with volume. Okay, with volume is it's not always like it's not necessary to get that volume, but it's obviously, it would be nice if you saw that, but it's definitely not a requirement of this. The theory behind this setup is that a value area high / value area low should act as a support / resistance level once broken. So what I mean by that is if you come above a value area high, then you would expect that to act as support. And if you go down below a value area low, you would expect it to act as resistance. Okay, and if you are in a range and the market is opening outside of the previous day's value area, but then gets accepted back into it, you would expect price to continue to range back to the other side of the previous day's value area. So pretty simple stuff. The theory behind this is really a pretty simple theory. What we're talking about is you have previous day's value area high, low, point of control. If your following day you're opening outside of value and you're already in the context that you're ranging, and you start to get acceptance between back below, for example, previous day's value area high, then you are expecting that range to continue. There's being no balance offset. The market is still balanced, and the market being balanced, you're going to expect that nice range to continue. There's no reason to expect higher prices if price is not being sustained above previous day's value area high. There's obviously no acceptance above that level, and people are happy to maintain this range trading. And that is what's happening more times than not. Okay, so this setup does not suggest, by the way, that every single time the market pierces the bottom of the previous day's value area that you should blindly enter a trade. It is very important to look at the context, and I have an example of this, of the last few days, as well as the other technical factors. So, with this setup, we're not suddenly forgetting everything. We're not suddenly not marking out our horizontals. We're not looking at Fibonacci. We're not looking at everything that we've covered thus far. We obviously are integrating this in with everything else. So if we enter this trade setup without checking for confluence or context, then you may as well go to a casino with this trade idea. This setup depends in your interpretation of overall market conditions, and through an understanding of confluences with other technical tools and market direction, you can decipher which trades to take under this setup and which ones are not so good. Okay, and I've got an example today of when I was presented with this trade setup, and when I openly said I'm not actually expecting this one to trade out today. And if you just see market open outside of value, and every time, for example, you're shorting that, then I really want to just emphasize, just go to the casino. Like, that is not technical analysis. You do have to have a very good understanding of market context, and just here, like, the overall market conditions. Like, are you overall trending? Are you range bound? What's the volume like? What's open interest like? These are all things that you're going to have to factor in before you enter the trade. And I've said it many times, you only want to take the highest probability trades, and to get those highest probability trades like this is, you do have to factor in confluences and market context, where you are, where it's trying to go. And how well is it, those 3 questions, like, where does the market want to do, where does it want to go, and is it doing a good job of getting to where it wants to go? Ask yourself and answer those questions before you take this trade. And this next point is 80% probability setup. I didn't think sounded so good. So I've put a name to this, and as I like to put names to these things, I've called it the CCV, and this stands for the acronym of Chart Champions Value. So CCV, chart champions value, because as you'll see that this setup is increasing above 80% probability. So let's just call it the CCV, and that's going to stand for chart champions value. And that's what I'm just going to refer to this setup as. It's much easier to just say. And yeah, I hope that I hope you like the name that I've put to this one. So we have a few different acronyms for many trade setups now, but it's coming together nicely. And this opening out of value, getting acceptance back in, is going to be known as the CCV. Very nice, easy to remember. So next slide. CCV. This is an example of a trade I didn't take. So let me first talk you through the setup and why I did not take this trade, even though the setup was officially there. So you can see here, here's our daily open. So the main three things that you're looking at for this setup, okay, is obviously your daily open, your previous day value area high, and your previous day value area low. And what we're saying is if we open outside of value, so if we're opening here 9,692, and we start to get acceptance below 9,620, we're saying we have 80% probabilities to reach 9,343, being the previous day's value area low. We're saying if we get this acceptance, and here this is 30-minute charts, so you see we get acceptance once and twice, 3 times, 4 times. So we're spending actually here 2 hours below previous day's value area high. And you might say to yourself, this is definitely, this is the setup, the criteria has been met. But as you can see, this is obviously from last week's stream, but today is obviously from last week. But yesterday was a good example of a short squeeze. So again, what am I referring to here? I'm referring to context. Today, I don't think we're going to get the drop. I didn't think that we would get this drop down to previous day's value area low. More interested in trading the range. I'm more interested in this higher range. Okay, I still have the same, then obviously done a live stream this morning, still felt that we had put in the range here. Okay, and in the end on this setup, I took a long position. Okay, and the take profit for my long was daily open, which is obviously back at 9,692. And so I want to really explain the context behind this one, and that's going to come now. Okay, so you can see here, yesterday is obviously last week now, but this is yesterday's setup, which did officially meet the criteria for the setup. But as I was saying in yesterday's members live stream, I would not be aggressive with the shorts on this setup, and I think that it's more likely we put in a range and not break down. Okay, so why was this? Try and think to yourself, why was this? Like, if you're just looking at this on the screen, if all I had was this information here, I would take this trade. I would short and I would target that if I had access to nothing else. But this is trading. We do have access to other information. We are not so blind to only look at what's happening today. We know before we take a trade in the morning, we do zoom out. We do look at more information, and we do acknowledge, what's happened yesterday. So why was I not expecting a breakdown the following day? Again, it comes to this. Okay, this is where we were that day. Okay, so we were obviously in a range here. We were in a range, and we had just had a break outside of that range. We had just broken outside of this range, and it was looking somewhat healthy at the time. Okay, so 10 days within a range, a breakout of that range. Okay, so why was I not shorting here and expecting price to come straight back down? Well, the context here behind this trade is that we have just broken out above value. Okay, we've just broken out above value, and there's no reason, there's nothing in the chart that's telling me we're going to get a rejection from here and fall straight back down, especially not straight away. Okay, especially not straight away. Okay, and you can see here that you gotta think, like, why would price break up above a level with a nice volume, and instead of retesting any resistance, like, it's not so often that you see this, on Bitcoin, where it's going to just break out of its range, put in its lower highs, lower lows, and just from here fall straight back down, when the volume is not telling you that that's likely. Okay, so we know that volume and open interest are key statistics that we're looking at. Okay, so when you're approaching these lows, which is obviously when some people are going to be taking their shorts aggressively, but you see signs of absorption. So when you see the bullish CVD divergences down there, when you're seeing the signs that there is a limit sat there absorbing price, people on market selling into it, you're seeing heavy selling, and price is not going down, that shows us the bigger player there is limit ordering and expecting higher prices, isn't it? So this is another form of context. The context originally is that we've just broken out a value where we can expect a pullback before an increase in price. For example, we can expect an increase in price, the slight flag, a retest before down, or we can just expect, you know, a range, new range to be put in here. But what we wouldn't necessarily be thinking of straight away is an increase in price that just suddenly falls straight back down. Obviously that can happen, and it does happen, but it's not the first thing that you'd be thinking of straight away, would it? Okay, you break out of a 10-day range. It's not the first thing that you think of that straight away it just, you know, V-shapes straight back down. Bitcoin generally puts in this range, builds up open interest, gets people offside before it would go back down. So that was the context behind this. And then here you can see, you know, when I was in that long position, I was obviously at the time looking for a Gartley, and my target for my first take profit was daily open, 9,692. Okay, you can see how this traded out. Price got those bullish CVD divergences, made its way back up, took out the last high, hits daily open to the dollar, by the way, to the dollar, hits daily open, and this actually rejected it did in the end reject all the way back down, you know, where we're sitting right now, 9,260, you know. So price did in the end V-shape all the way back down to these lower levels, but it didn't do it straight away. And this is where the context behind the trade is important. If you had shorted at these lows, you probably would have got stopped out as price retested daily open before its drop. Whereas if you can understand the context and why it was not as likely that you just went straight back down, then you can time the entries. And as you all know, timing the entries is really, really important, because if you correctly correctly work out where price is going, but you're premature to your entry, then you're probably going to get stopped out before price goes where you thought it was going to go. And the only thing that I can say of this is with time and experience, you will stop doing this. You will stop getting your early entries. You will be more patient as a trader. That I can almost guarantee. Like, it comes with time and experience. You know, that's just part of the game. It's unrealistic to expect to be able to understand the market conditions, you know, if you've only been trading a few years. You know, you do have to have that time in the market to gain a proper feeling for it, to be honest with you. And I obviously can't teach experience. That's something you need screen time for. But, you know, that was that. So here's a few more notes for you under this setup. So the distance from the daily open to the previous day value area and the width of the value area are two important components we are going to be reviewing before we enter a trade under this setup. So again, we're trying to get even more context, even more understanding of what the market's doing. If yesterday was range bound and the following day opens up outside a value area in a low volume range, one would expect this to be our perfect scenario for a setup. What I mean here is we've already had a tight sideways range, and we've now opened up outside of value on very low volume. It's not showing, you know, you've opened up outside of volume and there's no conviction to push price higher. You know, you've opened up outside of value, open interest has declined, volume is very low, there's no interest in buying at these higher prices. So naturally this would be our quote unquote perfect setup of price to come back to value area low of the previous day. And that's one that you'd be very aggressive on taking. You know, whereas if price has just broken out of a big range on large volume, you would have the setup rules met officially, but of course it does not make sense to trade this setup. So what I mean here is, if you've been going that same idea, let's take from the first one, you're in a sideways range, but in this example, instead of getting your perfect scenario where you get a slight increase, open outside of value, low volume, you know, decrease in open interest, you suddenly see a break of the range on a massive increase in volume, open interest going wild, increasing, everything pushing up really high. Let's say you go from 9,200, you're sat at 10,000 the next day. You're not going to suddenly look to short that, are you? Although you would officially have opened up outside of value. You know, it's just like the context of like where you are, where you're coming from. It's just like, I don't want you to just get so stuck into the thing of thinking, right, here we are with outside of value, we've got accepted. Like, you do have to take the context of where it's come from, how you've approached these levels into consideration. I just want to really emphasize that with this basically. So yesterday the setup this is now referring to those few slides back. We officially had the setup, but after having a strong move the day prior, it was very unlikely to fully reverse the whole move and more likely to remain range bound that day to allow open interest to build up. This is what Bitcoin does like to do. This happens time and time again, rather than V-shaping. And, I've said it many times, I don't like V-shaped moves. Like, it does not happen very often. Like, to just go up and straight back down, down and straight back up. Obviously, it can happen, but it's not as likely. From the statistics I have, it's not as likely. It's more likely to build that range. Okay, and why is this? So you can build up open interest, so you can build up more people caught offside. Whereas if you V-shape, you don't get that, do you? So we want to essentially wreck the most amount of people as possible. And how do you do that? You put in a range. Okay, pretty simple stuff. So now here are some examples of where it has worked. So all of these examples now are took the trades, made money. Easy trading. So here we have the context build up. Before we go over where we've opened, where we're going from, you can see here we're really simply in a range, aren't we? Price is not aggressively moving up here. Price is not aggressively moving down. This is a 1 hour chart. You can see for a few days here, you're just going sideways, aren't you? Really, 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 really sideways. This is absolute perfect for this trade setup. Okay, so you can see here the example that we have. And these are not hindsight trades. These are taken real in time, spoken about. Okay, so you can see here on this trade setup that you have had the daily open, okay, at $9,358. So your daily open is $9,358. Your previous day value area high is 9,348. Your previous day value area low is 9,260, basically. And so you can see here are your 30-minute candles. So here, 30 minutes, 30 minutes, 30 minutes. You can see we have now had almost, 1 hour here, 1.5 hours almost, closes within previous day's value area high. You can also see the volume is pretty heavy on this original drop down, not massive, but it's increasing, and this is just another step that we would like to see. Again, this is not a requirement. Volume doesn't have to increase here, but it's nice to see. And, when we start to get this acceptance within previous day's value area high, and the context is we are just range bound, the question is, why would you not take this trade? In this example now, you have the highest probabilities of a trade setup in your favor. You have the setup, and then you have the context that this is likely to play out. So you're starting to see the context that you're already range bound. Why would you not expect the range to continue? You're seeing the volume supporting that thesis. And then you're seeing open interest supporting that thesis. I mean, it's the question of take these setups. Like, why would you not take this trade setup? You can also see here locally how this was prior day's high. And you swing failure prior day's high. I'm trying to I hope you can see this. You swing failure prior day's high. Okay, so once you've done that as well, you've taken topside liquidity. You are expecting that to come, continue to range, aren't you? Basically. So you can see here anyway that you have a setup here with daily open, previous day's value area high. You're looking down for that, previous day's value area low. And you can see here on the chart, you do get that daily open. There's previous day's value area high, 9348, 9348. You go straight down. Again, target was 9.2. Officially, your previous day's value area low was 9,259. And you can see here that I took that short, 9,327. So slightly below previous day's value area high once we had that acceptance. And my close price, where I totally closed out of that trade, was 9,261. So I have front run previous day's value area low by about $2. Okay, $2. I've front run the previous day's value area low. And you can see here that price actually came down to 9270 on BitMEX. Okay, so again, the previous day's value area low was front run, and this is real sort of example where I have successfully traded this, the most perfect that you can get, like period. This was the most perfect trade that you could do that day, and price rebounded from here and auctioned back up higher, and literally closing to the very, very, very dollar low of that day. Like, it was just an insane trade. But you can see here how presetting your take profits, very good idea to do, and also waiting for the acceptance below. I'm not entering higher. I'm entering once we've seen the acceptance. That was our criteria on a context where we're already range bound. So this was a really nice trade, and I hope you all can fully understand this one. we're opening above value in a range. We get acceptance below previous day's value area high. So we are expecting this to auction down to the low and stay range bound. So from the lows back up to the highs, the lows back up to the highs. We're not expecting a breakout. We're not trading for a breakout. We're trading the range until it breaks. How do you break a range? You look for volume and open interest, generally speaking. Okay, so that was one day that we had this setup. And then literally the following day, after that setup had just played out, we had just absolutely nailed the high and the lows. The following day after that setup, we had a reverse setup come into play and once again traded perfectly. So the following day, we opened at 9,286. So it was the following day after this, 9,284. We opened that day, 9,286. We had the previous day's value area low at 9,309. The previous day's value area high at 9,382. We saw the acceptance here. You can see here on the A's, the B's, and the C's. Here is our 30-minute candles above previous day's value area low. There's your acceptance. There is your really quick move straight up to previous day's value area high, range bound, before getting another increase in price to top the day, 9435. And my resistances have been 9425. Yeah, this is another 2 days then in a row that we played the exact same setup and we made money on each setup. And this was not a difficult trade at all. Really simply, you have just completed this setup and you have just hit the previous day's value area low, and then exactly the exact same one after that day. You have just then been gifted the exact same setup to then trade it back up to the previous day's value area high. So once again, you are still range bound. You are trading the range until it breaks. Okay, and you can see here how this was this price, and you can see how you are just simply range bound. Okay, and actually, apologies, I just realized this screen was meant to go to this one. Oops. Yeah, this sorry about that. This picture here was actually related to this setup because once again we had another setup. And yeah, apologies, this one here, this 9155 is meant for this one, by the way. Oops. But you can see here how you open. So daily open 9,187. Previous day's value area high, 9,155. Previous day's value area low, 9,050. So what happens? We open up at 9,187, get a little increase in price before consolidation, a move back down below previous day's value area high, move back down, acceptance for 1, 2, 3, 4, 5, several hours here, acceptance down below, a little actual retest above previous day's value area high here, but then you eventually come back down below, a quick wick down to previous day's value area low. And then, as you will know, we just saw that move up. This was yesterday now. We've just seen that move up to about 9,300. So from previous day's value area low, taking profits at that low, we have just literally rose 9,300. So almost $250. And that was a setup from yesterday. Okay. And this was some notes that I had from this setup yesterday. So this is obviously what I posted in the group, that you have 80% probabilities of reaching 9,050. And this I want to emphasize of why I took this trade, the context behind this trade yesterday, and then a few questions that I found very interesting and that I can believe are very beneficial to you. Okay, so you can see here, open 9187. So just on the bigger screen here, open 9187. We're aiming for the target 9,050. Okay, so really, really simple stuff. And here are a few questions I'd like to highlight to you of what I was thinking on this. So you can see here as price was around 9,130, which would have been below previous day's value area high while we were sat around here. Okay, well, literally probably where you were sat here. I was asked, am I still in that short position? Obviously going for 9,050. And my answer was really simply, yes, I'm still in my short. I'm still targeting previous day's value, previous day's value area low. People are understanding the setup in the group now, which is nice. But now you have the full examples. So this the first question is why would I not why would I get out of this trade early? When I've had the criteria met, when I've identified the setup and I've taken the setup and firstly had a very, very good entry. I almost shorted the high here. Like I literally shorted the highs. So when I have literally shorted the highs, I've seen my acceptance. Like what would be the reason why I would not? Why would I get out of that trade? Like, why would I not still be short? And, that's the first thing you have to ask yourself is why would I not still be short in this setup? I have 80%, even higher maybe, like probabilities that we're going to here. I'm going to keep trading that. Why would I not take this trade, sort of thing? And then the second question, which I found very interesting, was, do I have preset take profits? And my answer to that was, yes, I do. So what that means is I had already set in the books take profit 1, take profit 2. And I was actually going for a front run of my first take profit was actually 9,100. And then I was looking for simply take profit 2 of 9,050. So really, 9,100. Apologies. I went 9,100. I went 9,065, and I went 9,050. So I actually had 3 take profits on this. But the thing is, I had them all preset in the books, and I don't always preset bids. So I don't always preset my take profits. There's a time and a place and the context required of times when I'm going to preset take profits, like in this, and times when I will not preset bids, and I will actually wait for price to come there and then think in the moment, am I going to take profits? Am I not going to take profits? And this is dependent on whether I think the move down will be quick and snap straight back up, or whether I think it's going to be grinding, and I will have that, edge of monitoring it in the time. Okay, so we know to always check context before we enter the trade. So really, really simply, we know to check this before we enter the trades. We know what we're going to be checking for. Okay, for example, yesterday, why was this context really, really nice? Because I was also, I was primarily trading off of the harmonic, wasn't I? If you can remember this in the group, and if you're watching this in 2025, then I was trading also off of a harmonic. So my original short entry was $9,218, and this short was taken from a harmonic originally. But then when I have the context of this trade setup as well as my harmonic, well, that's giving me even more power, like power level over 9,000, sort of like really, 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 really good trade setup. I'm seeing my CCV, and then I'm seeing my harmonic work, and then it's all coming together to give me extremely this trade is not going to fail sort of feeling. So we always know to check the context, to check other confluences before we enter the trade. Okay, if prior day was range bound, this increases the probability this setup will be taken. If we have just seen a massive range breakout, I'm very unlikely to be looking for this setup, or even if it comes into, even if like the example I showed you before, even when it's actually officially being, here's the setup, here it is, I'm still going to be monitoring. Are we seeing absorption? Are we actually seeing heavy selling and not moving down? Are we thinking, what's the likelihood of we just V-shape here? Or are we going to build up a little bit, test daily open? All of these different things that we can be thinking of, I am going to be reviewing, and I'm not just going to blindly roll the dice. We've been accepted back into value area, I'll take this trade. No, I'm going to be reviewing much more before I put my money on the line, essentially. If price closes outside of value and the following day gets accepted back into prior value area, price is telling us it is likely to continue to be range bound as the market works out its true value. So what I mean by this is when you are in that perfect scenario where you are just in a range, when you are getting accepted back out, back in, back out, back in, price is essentially just trying to work out its fair value. So there's a balance essentially between buyers and sellers. They are more than happy to buy the lows and sell the highs until you get the bigger player step in essentially and push that to where they want to push it. When value suddenly gets an acceptance of, people start agreeing that actually it's worth more, actually people start agreeing it's worth less, and this could be, fundamental factors, whatever it may be, price is going to move. Okay, and we obviously focus on the technical side of things, but nevertheless, when we're in a range, you just expect it to be range bound. There's no point in trading for the breakouts before they happen. Okay, look for the signs. Is it not going to break? And 4 trades here, essentially 3-4 trades where one, I recognized that it wasn't a good time to take it, and I was absolutely spot on. It wasn't a good time to take it. Every other setup that we've been given was actually under a criterion that it was likely to play out, and they all played out. So, and one of them, like that one yesterday, let me load up. Yeah, I guess I'll go over some questions now, and I'll try and load up where you ended on that one. So yeah, any questions now, please let me know, and I'll be more than happy to take your questions, and we can go over that. And let me show you this trade setup that I was on yesterday as well. And that was, we also had this harmonic here, yeah? So this is where I have my confluence. That was the confluence that I had from the high to the low to the high to the low to the high. That's where I had my short position. Okay, and obviously we did trade down to previous day's value area low, and you can see the reaction that we had off of that. Well, it really was a really nice trade. I'll try and show you. Yeah, and that was the original trade entry that I actually had there at 9139. Oh, sorry, at 9280, and obviously we come down in the end to 9,050, literally to the dollar there. Took those profits, and the rest is history. We had a lovely reaction off of it. So that was the Oops. Well, this is glitching out. But yeah, that was the context behind that trade. So yeah, any questions? Let's go over the questions and see if you do or do not have any. So here we do. Hello, Daniel. Should we expect the same results trading altcoins? And the answer is absolutely yes. This is going to work across any market, anything that you're trading. I would generally only trade something with high volume. Like, is this going to work on Stream Deck coin that like nobody's heard of, nobody trades, and the volume is like 0.001 Bitcoin a day? I'd say it's probably not going to work because who's trading it. But as long as it has good volume, I would say yes, it should work across everything, because it's more the view of value, and that shouldn't trade depending whether you're trading Bitcoin, whether you're trading Apple, whether you're trading Amazon, or whether you're trading Ethereum. All of the theory behind this is the same. So yes, the answer is it should work on anything. Obviously, it'd be good if you're trading some futures, and then you get the open interests. But yeah, it should work across everything. Hi, Daniel. What would make you get out of the trade before target at the other side of value area is met? Really good question. So, for example, I've entered the trade. So I guess referring back to this one, like, so the question of like, what would make me get out? So what would make me think, okay, I've taken a short, let's say here, and I'm looking for there. Where would I get out of this trade early? What would make me think it's not going to happen anymore? Well, I suppose it's if it starts to. I don't like to have so tight stop losses. So let's say I'm short 9130. My invalidation in this example, my invalidation when I'm taking a short here would actually be back above daily, probably back above that actual day's high. But again, don't take that like a hard rule, because I'm going to be looking at market structure. But I generally am going to be looking for one higher low, two higher lows back, a little bit of market structure as my invalidation. So that would obviously get me stopped out of the trade like fully. That's where I'd take a stop loss. But what would make me get out of the trade early? Well, it's probably going to be if we start getting acceptance back above previous day's value area high, like you did start to get here yesterday. And that's why if you were at this period, I wouldn't have taken a short. I'd have wanted to see it come back down below. But let's say I shorted here. If price started to close above it, but with an increase in volume, then I would close out the trade early. I'd be inclined to close out that trade early, because there's not actually a need to hold to stop loss. If I can get out with a really, really small loss, and price looks as if it's going to move up, then I'll get out with a really small loss. Like, there's no point to holding to invalidation if price is showing you that it's going to invalidate you, or likely to. Then I'd get out early. So I suppose if price starts to get back above the value areas and actually get acceptance once again above, but with an increase in volume and open interest, then yeah, I would close out early. So we have a few more questions. What about this trade setup on higher time frames, previous week, for example? Do you have experience with this? I mean, yes, this can work trading off of weekly time frames as well. So you could say on a weekly time frame, if you get acceptance back into previous week's value area low, then you're going to go to previous week's value area high. This is acceptable. I don't actually trade so much off of that because you all know how I trade. Like I don't like to trade like on these higher term timeframes like that. So for me, the daily is enough. But yeah, you can trade this on higher term timeframes. But for me, the theory is actually a little bit different. So when you're trying to like swing trade this, it is a little bit different, and that in my opinion does require a different live stream, because I would trade that setup, because you can definitely do it on a weekly, monthly time frame. But for me, the setup is a lot different. So I suppose for a really simple answer is yes, you can do this on higher term timeframes with the same theory in mind, but the way that I would actually trade it would be a lot different. But to answer your question in its most simplest form is yes, it does work on all time frames, but I personally would trade it in a different fashion to actually get the trigger for the entry. But that, I would say I need to do a whole live stream on that, because it's again different theory. But it's the same. It's under the same point of view of how you would look for it though. So next question is, what if the setup is presented but the risk to reward ratio is not good, like a 1-to-1? Would you still take it because it's a high probability trade? My answer to that is yes. So I don't always require for myself a nice 2-to-1 risk to reward ratio, 3-to-1 risk to reward ratio, 4-to-1 risk to reward ratio. And this is the thing, like, I've said it before, like I preach that you should only be taking these high probability trades. That's what I preach. But I don't do that. I will take these trade setups even if the risk to reward ratio is 1-to-1. Because if I have if I win $1 to lose $1, but I then have 80% probabilities that I'll win that dollar instead of losing it, then I'm going to take that trade. So yeah. The question is like, what? So to answer your question again, simply like, would I take it if it's a 1-to-1? My answer is yes. If my context is there and the probabilities are there, I'm going to take that trade even if it's a 1-to-1. But this is something you should really experiment with yourself, see how well this works for you. But yeah, I would take it. You only look for this setup when price ranges in the previous days, and you look for this only on the 30-minute charts. So yeah, obviously you could get in much earlier. If you start to see the volume coming on a 1-minute chart, you don't need to obviously wait for 2 30-minute candle closes, e.g. 1 hour close below. You can get in early, but the way that you look at this is 2 30-minute candle closes. But of course you can get in after 1-minute close if that 1-minute close below is on a massive increase in volume and open interest. You don't need to wait obviously for 2 30-minute candle closes, because sometimes you're going to miss that trade. On all of these examples that I've given you, and these are not cherry picked examples. These were literally over the last like 2 weeks now. Like, they're absolutely not cherry picked. Every setup that was given, these are the print screens. We only had 4 examples, and so I took every example, and you can see on all of them you had the acceptance of at least 1 hour before it drops. Okay, on all of them, you had the acceptance on at least 1 hour before it dropped. So so the question of you don't have to do this on a 30-minute chart. You can get in early, much earlier on a 1-minute chart. I will do that. I will do that. But yeah, officially you're looking for those 2 30-minute candle closes. But you can get in early if you see signs that you don't need to wait. But you can see from the examples I've given you, it sometimes does pay to wait. When you talk about open interest building, how does one view open interest building up? So really simply, come across to something like ExoCharts, and you can see, well, here's open interest slowly going down. By open interest building up, we mean something like this. Okay, so here's open interest. Let's just remove that and remove that. So you can see here how open interest like builds up. So I'm just talking about like an increase in open interest, whereas this is open interest going down. This is open interest building up. So we just mean open interest going up. That's what that's what I mean by open interest building up. This is open interest building up. This is open interest building up. This is open interest falling down. Okay, so that's that question. How do you know when to expect price to reaching take profits fast and when to expect price grinding? The simple answer to that is like, what So it does fall under liquidity. What's the liquidity like in the range that you're trading? What's the volume like in the range that you're trading? What's the open interest like in the range that you're trading? That is how I would judge whether you're going to grind or whether you're going to get that quick wick. And let me tell you this. Let me tell you this one. Like, this is a hard, cold fact. If I had not preset my bids yesterday, you could have been in the situation of getting into a short here, seeing your actual target hit, and then price instantly reversing and putting you underwater. So your winning trade could see really good profits and then instantly turn to a loss. So obviously knowing this in advance is really crucial, and that's why it was very good that I preset those ones. Because, you know, imagine you had that short, you wake up today, you're massively underwater, aren't you? So, you know, so the question is how. Obviously, I never know. I never can guarantee that it's going to do something. But I can say that it was more likely that we had only a quick wick down because of the fact, like, think of the context. Okay, so think of the context of this trade. Let's hope trading view is back to normal. Let's see if I can load it up now. So the context of this trade is we were trading. So let me just load it up one more time. I was trading this. Oops. Anyway, I was trading that harmonic pattern. I also know that at 9,065, which was one of my take profits, it is the low of our channel, which we've been trading from for over 50 days. This for me is a really, really, really important level. Okay, and on top of that, you were seeing, well, you were just like in a range, like, I don't know. For me, it was enough. For me, off of the channel, like, this is where my of the free take profits, my biggest was 9,600 and actually like 67, like a slight front run of the channel. And that's for me, the way that I trade, I suppose, I don't know, I recognize a range when it's happening or before it happens almost, and I don't want to get so greedy on it. Like, there's no need to get greedy on these setups, and it's not greed. Obviously, when I'm not presetting bids, it's not because I'm greedy, it's because I believe I have an edge in reviewing data as it's happening. But then there's also a time to realize when is it likely that you might not have that time to review it. I don't know. And like, for me, like, with that harmonic and being on top of the channel here, and being on top that we were just sideways, I don't know, it's worth, I don't know, in that example, for me, in this context, it was worth presetting my bids. And like, again, I didn't make this up. Like, that was hard written in the chat sort of thing. And obviously that was a really good decision because we saw that quick wick down. If you didn't preset bids, you could have instantly lost money, especially then it grinded and you got and getting that acceptance back above now. So, yeah, I mean, to answer the question though, really simply, what I'd be looking for there, okay, back to here, sorry, is what we'd be looking for is really simply like open interest, where's liquidity, and what's the context of, like, are you expecting a break above a major pivot high? And in that case, maybe I wouldn't actually preset bids because I'd want to see how it reacts. You know, if I'm looking at a really major level, then I'd probably want to I probably would not preset bids. You know, if we, for example, approach like 10,000, I'd want to be there in the action and review what's happening rather than like presetting a shorter 10k sort of thing. In that, so yeah, it's so context dependent, and I know that's not the easiest. You know, that's probably not what you want to hear, because you want to give you'd like me to give you like a hard set of rules, like this is when you do it, this is not when you do it. And I know my answer is very open, but that is trading. There is no like hard written rules. It is very much, you know, every setup has a different, a context of where it's come from. You know, this is why RSI divergences, they sometimes work, they sometimes don't. And if you can understand the contexts behind this, of why they're working, why they're not working, then obviously that, you know, a simple tool like I like the RSI can work if you can truly understand like why it works and when it doesn't work. So, you know, just like this setup, I know when to take it, I know not when to take it. Some people might use this setup and have a 0% win rate because they don't know when to take it, when to not to take it, sort of thing, you know. But again, yeah, it's context dependent. So where is invalidation once you take the trade? So my invalidation off of this is not based off of the previous, it's based off a market structure, really simply. Okay, so let's come back to here. If I was, you know, shorting here yesterday when we were getting accepted back into value, my stop loss would be, or my invalidation would be back above those highs. Really simply, I would say to myself, if price gets back above here, I want to be out of that trade. That's not what I would want to see happen. Okay, so you know, for me, I would go off a market structure. I wouldn't really use previous day's value area high. So if we got accepted below it here and there's previous day's value area high, I wouldn't use that as a stop loss, to be honest. Like, I wouldn't use that as a stop loss. If I wanted to put a hard stop loss, it would be above the high, because that's actually invalidating my setup. You know, in my opinion, that's the invalidation. You know, here, you know, you could have, as you saw, you know, let's imagine that you had your stop loss literally above previous day's value area high. Let's say you shorted 9140, you had your stop loss 9160, you got stopped out, and then it went straight to target. Like, that's why we use market structure. Anyway, that's why I use market structure for my invalidations, not so much just the numbers within it. Because it's, you know, it's a little bit choppy, a little bit sideways. You don't want to have to. I never give myself really close, tight stop losses, like, period. Like, I never, ever, never use a really, really small stop loss, because more times than not, you're actually going to lose money by using a tight stop loss than if you just let your trade idea run. So I'm a really big fan of wide stop losses. And obviously that can mean smaller position sizes, but I would, you know, if I suddenly started using really small stop losses, I can guarantee I would lose a lot more trades. And people use small stop losses because they're so scared of losing money, but actually it makes them lose more money by having those small stop losses. That's my opinion. You know, so see what else we have in here. Oops, sorry about that. Next question is, if you don't have Exo charts, can you use session volume on TradingView? Yes, you can use session volume, but I'm a big advocate of Exo charts, Sierra charts, Atos. I'm not such a fan of TradingView session view, because the formula actually behind the workings out are different. I mean, yeah, you can use session volume on TradingView, but yeah, you can use session volume on TradingView, but I don't know. I just personally much prefer Trading Technologies. If you have the cash, Trading Technologies are really good. Exo charts, Sierra charts, Atos is free. You know, Atos is free, so I personally would think it's better than TradingView, but you can definitely use this on TradingView, but you might have like slight discrepancies in the numbers. So how can we calculate value area on other assets such as without such tools as Exo? Any dedicated? No, I have no. The formula to work out the value area is 70 to 68%. So let's say I guess you could work out manually. Like, I would not waste my time doing this because I have a computer to do it for me. But let's say you wanted to do it manually, or let's say you have your days range. You'd have to look at the volume of the days range, and then your value area is the 70%. Okay. So your excess above and your excess below, and then the majority of that 70% volume, that's the value area. Okay, where that 70% or 68% is where you've traded, that's where the volume has built up, that's where you get your. So you can do it manually, but I would not advise it, because you're going to be sat there all day and you're going to miss the trade. But you know, just use the computer, it's going to literally just tell you. But I guess if you wanted to do it manually, then yeah, it's 70% of the value in terms of volume where it's traded horizontally, and then you would work out your value area. But I can, yeah. Hi Daniel, is the setup the same for other traditional assets? Yes, this is going to be the same across everything. Like, any asset is going to be the same theory behind this trade. So you know, you should see it work on Apple, Amazon, all your stocks. You know. Let's say that you have stop loss above previous day's value area high. Does the distance between previous day's value area high and previous day's value area low have to be twice the distance to stop loss to this trade setup? So I guess this question is more or less another one of, do we only take it if it's a 2-to-1 risk to reward ratio? Essentially, that's what the question is. And you know, my answer is I will take it if it's a 1-to-1. You know, I'll take it if it's a 1-to-1. So in my answer to you is it doesn't have to be double the distance, but I want you to experiment with this yourself. Please don't just start taking these trades and putting like a lot of money on the line just after watching this video, because it's actually unrealistic to expect you to, you know, just by watching the video and understanding the theory does not mean that you can be a really good trader. You do have to understand so many like more little nuances in trading. So I just recommend that you test this yourself. Like, you know, everybody after this video, just pay attention to the setups, even just like make notes. What have I bought here? What have I sold here? What have I, you know, how did it go? How could have I improved? You know, I'm happy to take 1-to-1 trades, but then I don't know, I'm good at this. So I don't know, I'm good at reading the market. Whereas, you might not be so good at reading the market. And that's obviously normal if you're only been trading, 3 whatever years. So, yeah, but to answer your question really simply, like I would take a 1-to-1. So for me, it doesn't have to be double the distance. But then actually, there are going to be times where I'll take it where my targets for $1 and my stop loss is $2 away. So I'm taking like a negative almost risk reward ratio trade. But if I see the probabilities are there for that trade, I don't really care if I'm trading $1 to potentially lose 2. If I can almost guarantee I'm going to win that dollar, I'll take it. But again, it's so context dependent. I don't have exit charts. Could you explain in TradingView how to identify the setup? Okay, so it's a little bit more difficult, but let's say that here's your daily open. Well, let's just do it properly then. So your daily open is going to be on this candle. Well, let's do it for today. Yeah, let's do it for today. So our daily open was, and I never do this manually, by the way, so this is a first for me. But our daily open here was on this candle. So our daily open was at $9,132. Okay, so then we could use something like a fixed range from our daily open, which was here. So here, our previous day would bring us back to here. So we've opened here, and our previous day's value area low was here. Our previous day's value area high was here. But you can see we've opened up within value, so we never had this set up. Let's just say, for the sake of an example, that we actually opened here. We opened outside of value. We started to get our acceptance back into value. This is a 1-hour chart. We have a 1-hour close above here. And then we would have longed here to trade back up to this high. And you can see that would have been a nice trade, actually, because you would have hit up to value area high previous day. You got a little pullback, and then you got this really nice increase in price. Again, with like the market structure here that has actually been going pretty nice, we have to admit, because it has been going higher highs, higher lows. Here's another higher high, So, yeah. So that's how you do it manually in TradingView. I mean, I don't do this. I don't know. I don't know. Yeah, the only reason I don't do this is because I'm happy. I pay for the software. But if I didn't want to do that and I wanted to do it in TradingView, there's the exact example of how you do it. You have to look at the daily open, see where the daily open is, take the fixed range of the last 24 hours, and yeah, absolutely, you can do it manually. But it's just going to be a little bit more time consuming. Okay. Hi Daniel, for traditional assets, which order flow program do you recommend? I personally recommend trading technology. Like I use Trading Technologies, but the problem with this is the software is about $1,500 a month. So it's hard for me to really recommend that to people because the likelihood is that you're going to be paying more for the software than you're making a month. So obviously that doesn't make sense. So in that regards, if you are not making, there's no point in paying for that software if you don't make that money. It just doesn't make sense. So in that regards, then I would say your second best, like for me, Trading Technology is number one, but the second best option would be Sierra Charts. Sierra Charts, you have to pay for the data, and this is the thing. Like, the data of this is actually a lot more expensive than cryptocurrency. This is why cryptocurrency is like very advantageous to newer traders, because you don't have to start paying hundreds of dollars on real-time data. So but nevertheless, in terms of software, you will have to pay for the data on top of this. But Sierra Charts, Atos, but again, Atos, you're going to have to pay for the data. But these are, I would say Sierra Charts is your sort of more or less entry-level program for this, which is not massively expensive. Yep, so there you go. And the last question that I have here, which has come in from our good friend Igor, would you say easier visually to identify the CCV setup with a TPO chart in, say, EXO? Yeah, so whenever I'm looking at this, like, you all know I'm a big fan of EXO charts now. Yeah, I never used to use EXO charts like a year ago. Well, EXO charts didn't exist a year ago, so I'd have found it hard. So yeah, now it exists. I use EXO charts because I love this software. But yeah, it's obviously really easy to do it in EXO charts because what do I have straight away? I have marked out. Okay, so in my marker settings, I have the previous day value area high, point of control, value area low. I have the developing day, like all I would need is marked out this daily open. I can see straight away, really like it's just giving me instantly the daily open, previous day's point of control, value area high, value area low. And to make it really simple, you don't even need the previous day's point of control. Like you don't need that in this one. You just need that, and that. And again, you don't actually have to use, I like TPO charts, yeah. But you could do this on our standard setup here. You don't need TPO charts, you know. You could use this and just change to like a 30-minute time frame. And this exact setup that you're all used to seeing, you would then just have to have your marker settings on of your developing day, daily open, previous days here. And here you go. Like here's the standard delta cluster with the setup on the screen. Okay, a daily open, lows and highs, 30-minute candle closes. So if you see 2 of these 30-minute candle closes, and we're going to not be using 20 ticks, but you know, we're going to be down like this. And so then when we start to see, you know, these closes, so if we were trading this today, let's say we open here, you come down below, we get this acceptance here. There's previous day's value area low right here, yeah. We get 30-minute candle close above, 1 hour, 1.5, 2 hours, reaction. You know, like here would be longing. Like here would be longing if this was the setup. Let's say we opened here. Like here would be entering our longs. We back test that. And then as you all know, you like auction up really nicely. So, yeah, to answer your question there, Igor, I personally like it in TPOs and in XO, yeah. But that's by no way means a requirement. You can use this. You know, this is a template that I've shared with you all. So this is, you know, this is the exact template. Here you can look at those CVD divergences. Like, are you getting absorption at the lows? Are you not getting absorption? Like, these are things that we're looking at. What's the volume like as we're approaching these lows? So you can see here, actually, this is a really nice example. Again, this wasn't officially met, but you can see from this low to this low. Okay, what you're seeing here, you're seeing really aggressive selling of the lows. So 30 million here, negative 2 million delta. Here you're seeing 38 million, negative 11 million delta. So more selling at this low than this low, but you are not making a new low. Okay, it's a higher low. And also look at the delta. I mean, the CVD, like you're seeing massive bullish divergences, aren't you? Price making a higher low and delta CVD is making a much bigger lower low. So this is really big bullish CVD divergences. Okay, so these are the sort of things you're looking at anyway. Like these are things, you know, you're taking the volume. Okay, we'd also be looking at what's the open interest doing. Obviously, this was a nice move. Like I think this was a nice move because the open interest, by the way, on this one was nice. Look at the volume, look at the open interest, really good. But nevertheless, like these are all the things that we'd be looking at. Specifically, the volume down here in the delta. Like we're looking at delta. You know, these are just, yeah. So, but to answer your question, sorry, is I like it on TVO, but you can use any of them. You know, they're all the same here. In that regards, you know, it's down to personal preference, I suppose. In this setup, it's down to personal preference. Like, yeah. So, yeah, those are all the questions then that have come in here. So I hope that you've thoroughly enjoyed this live stream. You understand what you're looking for with the where you opened a day and then getting the acceptance back into the, you know, the value area. So essentially we're always trading the value until you get a break from value. So really simply put, okay, if price closes outside of value and the following day gets accepted back into the back into the value area, price is telling us it wants to continue to be range bound and we're trading the range until it breaks. So really, what do you have now? Like, how has this stream helped you to become a better trader? Firstly, I've put it into your brain very much so we're only taking the highest probability trades and we are looking at context before we take every trade. We are then, secondly, we know when to enter this setup. We know what exactly we're looking for. We're looking for price to get accepted back into that value area. And thirdly, we know to be checking volume and open interest statistics and delta statistics like as we get that acceptance. These are beneficial things to see. Okay, so we're trading the range until it breaks, essentially. Okay, and we are then using these extra bonuses, extra little tips, extra little ways to get ahead of the majority, like little edges, I suppose. We're using these edges to make money, like simple when we're using this to make money. So yeah, those are the takeaway points from today's video. And yeah, I hope that you've all thoroughly enjoyed it. If you have any questions, please just leave me a comment in Discord, I suppose, because there's no other ones that have come in. Yes, of course, don't forget the announcement. I'll give this announcement really quickly. I'm going to do a video. I think I might do a video about this as well. But basically, yeah, really big announcement that the Chart Champions website is going to be live tomorrow. So we're going live with it tomorrow. Going to be really, really, really good of it. We actually wanted to not release it tomorrow, but as you know, we've had a lot of problems recently with the DDoS attacks, so we've kind of been almost forced to bring this release forwards. So yeah, it's going to be tomorrow. I think you're going to absolutely love it, because the website in terms of content has been improved. We have the abbreviations of all the lists of everything that's happening. We've got timestamps for every video. You know, it's all getting better and it's all improving. And tomorrow the new website will be live, so you won't actually notice any difference. You'll have the same logins. Everything will be the same. All I would stress is that, you know, this has been brought forwards. We haven't done full testing on everything. There might be design glitches. We do actually want to change the design, by the way, and that's a work in progress. But if you notice any glitches, any things that's, you know, slightly off, then please just let us know, and you know, we can fix that as soon as possible. So yeah, your feedback will be thoroughly much appreciated as always, and I hope that you thoroughly enjoyed a new website tomorrow. I think you're going to love it. So yeah, there's that. I hope that you've thoroughly enjoyed this stream. Hope you enjoyed our new website tomorrow. And, you know, keep building, keep working hard. And, you know, I truly believe I'm giving you everything that you need and more to really crush these charts and make money. So, you know, there you go. I hope you enjoy, and I'll catch you in the next stream. Cheers, everybody. Thank you, and goodbye. Bye.